Income Tax 2020 Tax Software Example Residential Rental Property Introduction. Come in, relax with Income Tax 2021. Here we are in our Intuit tax software. You don't need the tax software to follow along, although I do think they have a 30-day free trial, so if you can get access to a promotional version or a demo version to practice with, it could be a good tool. We're going to be focusing in here on the Form 1040, the related Schedule E for rental property. We're going to be going back and forth from the data input to the forms to run different scenarios, software helping us to do so. We're going to start off with our scenario of the single filer, Eric Smith, living in Beverly Hills 90210. We've got the $50,000 as the starting point on the W-2 wages. The point we're focusing in on here is going to be line 8 for the 1040. That's where the Schedule E income is flowing in. It's going from the Schedule E to the Schedule 1 and then ultimately here to the 1040. And then that's going to give us our $70,000 of the total income. We have the standard deduction, $12,400, to give us the taxable income at the $57,600. So then we're going to be looking at the Schedule E. So the Schedule E looks like this. We just got a couple things filled out in it at this point. We'll get into it more detail on some of the line items in a future presentation. But it looks like this. Bottom line of the Schedule C, this is in essence an income statement similar to a Schedule C. This time it related to rental property, however. Bottom line here, $20,000 then flowing into the Schedule 1. So basically the net income of the Schedule E, the rental property, flowing into Schedule 1. And that's on line 5 for the rental real estate, royalties, partnership, S Corp, and so on. That flows down to line 9 of the Schedule 1, which then flows over to the 1040. The 1040 on schedule on line 8. 1040 on line 8. Now note what we do not have here, as we did have on the Schedule C, generally we don't have to deal with the self-employment tax, which is huge because the self-employment tax could be a big tax that is going to be imposed, and it complicates things a lot as well. So in general, we don't have the self-employment tax related to the Schedule E. That's going to be a benefit of the Schedule E, makes it a little bit easier. The more difficult things on the Schedule E logistically, or generally when you're working with clients or doing this yourself, is it more likely that the Schedule E is going to have issues with losses. So you may well run into clients that have losses on the Schedule E, and then you got to be determining as to whether they're going to be able to take the loss. You may well run into situations where they're using the property both for rental and personal use, either as their primary home that they're renting part of it, or possibly as rental property that's vacation home and rental property or something like that. They're using it for some part of the year. So that's going to be a concern. And then another concern is that there's often the related party kind of transactions that could take place, meaning you want to rent the property to, a sibling or something like that, or a son or something that's related to the party, and then or related to the family. And then you got to deal with those kind of issues. So those are kind of issues that will often come up with the Schedule E that you may not see as much with like a Schedule C type of business. So the basic layout of the form, however, is going to be similar to a Schedule C. So we've got the Schedule E form, supplemental income. This is real estate, royalties, partnership, and so on. We're going to be focusing in on basically rental income. So we have the income or loss from the rental real estate. So we have the physical address this is the address. This is not the same address of the home they live in, although it's also in Beverly Hills 90210. This is a home for sale, by the way, if you have a few $1 million and you wanted to spend on it. But that's going to be that. And then the type of property, the fair rental days, we're going to say we're renting it for 365 days. So we're going to say we're renting it for the year. Then we'll have the rents received, basically the income, of course, up top. If we had multiple rental properties, then we can use the Schedule E where we would have multiple columns that can add up the multiple properties. We need to add up the Schedule E's that are kind of related in case we need to apply kind of passive activity limitation rules to the Schedule E, the different Schedule E type of properties. So we might look at multiple properties in a future presentation. And then you've got your normal kind of expenses here. So rental income is more standardized in some ways than it's like a Schedule C business where they could be doing anything. You don't know what they're doing with a Schedule C business. So it's harder to standardize the expenses. With rental property, they're renting the property, and therefore you would think the expenses would fall in pretty more into alignment with the expenses that can be guessed or standardized expenses. So advertising, auto and travel, cleaning, commission, insurance, legal and other professional management fees if they have a management company, mortgage interest and points. So that's just like kind of like the mortgage interest on your Schedule A that you would deduct, except this time the mortgage interest is basically a business expense or rental expense because you have the mortgage in order to help you to generate the revenue. And that would mean that this makes more sense in essence to deduct it, right? Because now you're paying the mortgage in order to generate revenue as opposed to a personal reason for your personal residence. So then the other interest, repairs, supplies, taxes, utilities, then depreciation. Now we may talk a little bit more about depreciation later, but depreciation is a huge topic in and of itself. But obviously whatever property you have, the rental property, the cost of the rental property is going to be a big expense. You can't expense it all at once. You have to basically depreciate it and expense it over, the useful life, which will be determined by the code in essence. And so the method and the number of years you depreciate over will be largely determined by the code. So then any other expenses would be going here. We then have the total expenses. We subtract that out and we got basically our net income of the $20,000. So then down below, we might have multiple properties that you can basically add in together, the multiple properties that would be taking place. In essence, our $20,000 then flowing in down below on line 24. And we don't have any losses at that point. That's going to be the $20,000 that then flows into the other schedules. If we look at the data input screen, it can give you some ideas of a couple other things that we need to basically keep in mind with the Schedule E. So here's the data. So here we have the type of property. We got the number of days that could be in effect if you had something other than a full year, the 365 days. These questions could be affecting basically the impact of the losses. So did not actively participate. So did you or did you not actively participate? And the real estate professional, we might talk more about them later. And then of course we've got the income statement information. Now, what if we said we had a loss here? Now remember, the loss is something that's fairly common in rental property. And it's something that the IRS is going to be concerned about, and it can be quite significant in terms of the losses because we're talking about big numbers here, especially if you're depreciating the actual property itself, right? So let's say we had a loss on the $10,000 loss. So now we've got this loss, and there's the $10,000. Now with the passive income rules, you would think you'd only be able to take the losses up to the point in time or up to the amount of income, meaning you couldn't take the $10,000 because you have no passive income. And then you'd have to carry it forward. But there's basically an exception, so we're going to be able to carry this then to the first page of the 1040, and we're taking that loss against the $50,000 of income there. Now, if we make that loss more significant, let's make the loss going up to, let's make this $90,000 here, and I'm going to go back on over and check out the loss. So now we've got a loss of $40,000, so a $40,000 loss. And then the deductible rental real estate loss after limitation, if any, on Form 8582 is $25,000. So if I go to Form 8582, they're limiting the loss now. So I go back up top. This is the passive activity loss limitations. So the activity here, we've got the $40,000 of the losses, and that's going to be our $40,000. And then it's basically capping it at the $25,000, which is kind of like the general rule. So it's capped at the $25,000. That's how much of the loss. This is the total loss allowed from the passive activity. And that then is what's pulling then forward to the 1040, the $25,000. That's basically the passive activity rules kind of kicking into place. The rest of the loss, maybe you can take, in future years, you do a similar calculation, possibly rolling over the loss into future years. This fact that you have to roll over the losses makes the rental income complicated, and because you're going to have depreciation and you're going to have this loss rollover. So that means that if you did the return in the software in the prior year, those rollovers will happen or be there for you. If you roll this over in the software, then you should be okay. If you're doing tax returns that have rental income and they're new, they did the return somewhere else in some other software, then I would enter, that would be a more complex return, complex enough. Say for 2020 return, I would first enter it into the 2019 software, match it all up, get acquainted with the return, then roll it forward so that all the rollovers will come over automatically rather than trying to enter the rollovers into the current year. I'd rather check the whole tax return if possible, if it's a complex tax return and we're trying to build a long-standing relationship with the client. I think it's normally worthwhile to do that. Now, so then the next thing we could take a look at is what if they were a real estate professional, or what if they did not actively participate? We'll say they didn't actively participate, and then I'm going to go back on over, and now they're not getting any of the loss, right? We've got the form that's restricting the loss here. The passive activity losses, 8582, is now restricting it. So we've got this idea of, well, what does it mean to be actively participating? Because if there's a loss, we would like to be taking, that 25 of the loss if possible, right? So now you got that question about, we got to make sure that they're actively participating if they want to take any of the losses that would otherwise be passive and not being able to take unless you had some other passive income. And then what if we said, okay, what if they are a real estate professional? They're now a real estate professional now. Not only do they actively participate, but they're a real estate professional. So now we got the whole 40,000 loss here. And that's basically because they're saying, hey, this is for people that say, hey, this isn't just passive income to me. This is my active business. I do this full time. I'm a real estate professional. So you shouldn't be limiting my losses. I actively participate. Not only that, but this is my main source of income. This isn't like my rental property, basically, is the argument there. So now they're getting the full loss and they're not being limited by the passive loss limitations. So that means that if there are losses, you want to be considering, okay, are they actively participating? Are they a real estate professional? Or are they not actively participating? And that's going to be significant. And of course, those types of determinations you'd need to support in the event of an audit.